Well, US markets continue to ride high on the post-Trump enthusiasm, but for once it appears most global markets aren't following them. Hi there everyone, welcome to the Traders Circle Weekly Market Update. Today is Tuesday, the 12th of November, 2024, and before I get started, you do need to be aware that whatever I say is general advice only. So like I said, US markets have pushed into a series of all-time highs following Trump's presidential election last week. And why shouldn't they? Trump has proved in the past that he measures his success by the success of the stock market. He's enacted policies that favor, very large businesses, large corporations. He's signaled he's looking to cut corporate taxes and do other things that, should help to boost stock prices. So it's no surprise that US markets, the S&P 500, the Nasdaq, the Dow Jones, they've reached fresh all-time highs. But for once this year, we haven't seen other global markets go with them. We've seen the Australian market struggle to get back to its own all-time high. The Japanese market hasn't pushed back to its all-time highs. The Chinese markets have seen selling, as have European markets. Now, there's a few reasons for that. It could be that they're already extremely expensive, and a lot of the potential Trump optimism is mostly focused on US shares. So the corporate tax rate cuts, it's going to favor US companies, obviously. And if there are tariffs put in, they could hurt companies around the world. The other thing, though, that I would sort of point towards is that the proposed economic policies of Donald Trump are likely to be a bit inflationary. I'm talking about the tax cuts. Already the US government's in a huge deficit. If that increases the deficit, it's more net spending from the US government. That could be inflationary. And the proposed tariffs as well are likely to be inflationary. And so we've seen bond yields rise. And bond yields have been rising really since the September Fed rate cut. But as those US bond yields rise, as global bond yields rise, it does make shares less attractive. And so that could be another reason why global markets outside of the US have really struggled to keep pace with the recent US gains. Just on that as well, we will see a US inflation reading tomorrow night. It's going to come through probably early Thursday morning Australian time, and inflation is expected to be broadly in line for October with September's numbers. That's not what US markets want to see. They want to see inflation continue to fall, especially considering the Federal Reserve has started to cut interest rates. If inflation actually goes back up, if it doesn't continue to fall, and if it actually goes back up, we really need to start to question whether all these rate cuts that have been factored in are actually going to come. Markets are expecting, another 2% of rate cuts from here, basically, and that can only happen if inflation continues to trend lower. And like I said before, Trump's economic policies are unlikely to help inflation continue to come back down. And so, if the reading starts to suggest that inflation isn't coming back down either, I think there could be a bit of volatility in markets. So that's a very important reading to watch. Like I said, late Wednesday night, early Thursday morning Australian time, and the Australian market will wake up to the reaction on that reading. I do want to say that if there is anything that's going to disrupt this market, I do think a re-emergence of inflation could be something to look towards. And like I said before, huge amounts of US government deficits, those are inflationary. US government is printing money at the fastest pace it ever has, trillions of dollars every year, and that has to go somewhere. Obviously, it's going to risk assets, but it could also be going to, consumer spending. Finally, and more specifically for the Australian market, we've got the iron ore weakness and we've got the bank reporting. The iron ore price has really come off the past week. There's a few reasons for that. Mostly it's because the Chinese government has disappointed investors with their stimulus measures. In Western markets, in Western economies, Western politicians tend to try and go for a sledgehammer approach with regards to stimulus. They want to be seen to be doing a lot. They want that short-term boost to ratings, to popularity, to sentiment, and so they go for shock and awe, and they hope that that leads to greater approval from voters more than anything. That can also mean greater approval from the share market, though, and it tends to lead to really short-term hopes and dreams, and if anything, they don't really care what the effects might be in sort of 4 years' time, or 5 years' time, or 10 years' time. That's not really what we've seen with the Chinese market and the Chinese economy and the Chinese government. If anything, the Chinese government has taken a more cautious approach to the stimulus, and they're doing it little bit by little bit, small announcements here, small announcements there, but nothing to really sort of wow markets and say, oh, okay, a bunch of money is going to flow back into here. And as a result, they've disappointed investors a little bit, at least in the short term. And I think that's caused a little bit of a downwards movement in the iron ore price. It's led to a little bit of selling in our iron ore miners. In addition to that, the Trump election has also sort of caused a bit of negative sentiment. His proposed tariffs, memories of the previous US-China trade war, and that's also, I think, dampened iron ore prices a bit and also triggered a bit of selling in the iron ore miners. So as those iron ore miners have come off, the banks have had to push back up to keep our market, holding somewhat of a semblance of joining in the global share market gains, somewhat following US markets higher. And that's despite the bank reporting. That's despite the local reporting from ANZ, NAB, Westpac and Macquarie, which was pretty terrible, to be honest. It was pretty atrocious. Now, it's all well and good to say, well, things might turn around for the banks from here. They're going to cut expenses, and that's going to basically lead to increased profit margins in future. But overall, really, we saw a drop in earnings, 8 to 9% for ANZ, a little bit less for Westpac. We saw net interest margins be squeezed on average. We saw return on equities come down. In some cases, the dividend was dropped. And to be honest, I thought the bank reporting was atrocious. Some worse than others, and obviously, we'll see CBA's quarterly update tomorrow, and that could be a bit different. But to me, the reports certainly do not justify the current share prices on the banks. It's a little bit ridiculous, and I think it just goes to show how much our market sort of is kind of broken away from the local fundamentals, the local situation, and really it is just sort of a speculative betting market derived from US market movements. That won't be the case forever, but it's the reality that we're in at the moment. CBA will no doubt have a pretty decent report tomorrow compared to the other banks, but it certainly doesn't justify it being the most expensive bank on earth. You can go out and you can read, some analysts try to, squint and justify, some semblance of a price even close to the current share price for CBA. They'll come up short. They'll come up with sort of weird alternative explanations, and even then it's a huge stretch. So, regardless of what CBA reports tomorrow, probably doesn't justify the current share price. Certainly the other banks didn't justify their share prices with their reporting. And it's really going to be, I guess, a bit of an issue for the Australian market moving into the next sort of few years. What's going to drive our market with these banks really struggling to grow their earnings from here. But regardless, they have pushed up afterwards. Most of them dropped about 2 to 3% and then pushed right back up. And, I could easily see CBA doing something similar, dropping initially and pushing right back up just to keep our own XJO index following global indexes, following the US share market index. If the US does start to downtrend, if they have a meaningful correction, if their bull market does end, it does not spell good news for the Australian market. But until then, I think those banks are largely going to follow what happens in US markets. So let's have a look at the charts for this week. Let's start with our own market, the XJO, and we can see that we fell off to roughly 81.20, and then we pushed back up to sort of 82.80, which was our previous all-time high resistance. Despite the pretty extreme strength in the US, we weren't able to go back to the recent all-time high, and that's at roughly sort of 83.50 to 83.80. If the US market can keep rising from here, I think we will push back up there, but I'm actually anticipating that the US market will start to see a bit of profit taking soon, and that could push us back towards the recent lows around 81.20. Regardless though, you have to assume further sideways movement for our market with perhaps a slight bullish slant. So sideways to bullish for our market as long as US markets hold up. And just looking at the US markets, this is a chart of their S&P 500, and we can see the post-Trump rally here. So basically they jumped immediately through the previous all-time high, 5,900 after the Trump election, and they ground a few sessions higher after that. Overall, the momentum seems to have stalled a little bit for the US market. They've really struggled to add many points over the past 2 sessions, and my personal belief is we will see some profit-taking creep in soon. Like I said, Trump's policies could be inflationary, and if they don't see these rate cuts that have been forecast for the last few years, if we don't see 2% in interest rate drops from here, shares are going to look extremely expensive. If they do see a bit of a pullback, I'd be looking around 5,900 as the immediate downside target. If the CPI or inflation data on Wednesday night is stronger than expected, we could see that level break as well. Regardless, though, they remain on an uptrend. They remain bullish, and until we see pretty much a revision of the Fed's interest rate cuts, until they change their tune and pivot again, perhaps, they're likely to continue grinding sideways to higher at the very least, if not jumping strongly higher. So I will wrap it up there for this week, guys. Hopefully you enjoyed. If you did, click like, click subscribe, and we'll see you next time.